On December 7, 2025, the world woke to a seismic announcement. Saudi Arabia and Qatar had officially joined BRICS+, and, in a move that stunned global markets, both nations declared they would begin accepting Chinese Yuan for their oil and gas exports. This decision sent shockwaves through financial centers from New York to London to Hong Kong, as the implications became clear almost instantly. This wasn't just a diplomatic shift, it was a direct challenge to the petrodollar system that had underpinned global finance and trade for over half a century, anchoring the US dollar as the world's reserve currency, and giving America unparalleled leverage over international markets. The US dollar's dominance in energy trade had long ensured American economic power and global influence, allowing the United States to project strength far beyond its borders and shape the rules of the global economy. Now, two of America's closest Gulf allies were rewriting the rules of the game, signaling a new era of strategic autonomy and independence from Western financial systems. Their decision marked a bold step toward reshaping alliances and forging new partnerships. The move was abrupt, not gradual, a tectonic shift in the world order that caught many by surprise. Markets reeled as investors scrambled to assess the long-term consequences of this unprecedented realignment. Official statements spoke of diversifying partnerships and economic resilience, but the message was unmistakable. The Global South, led by China and now joined by Middle Eastern energy giants, was building its own financial architecture, independent of Western dominance. The implications were immediate and profound, sparking a chain reaction across markets and capitals. Currencies fluctuated, oil prices shifted, and governments convened emergency meetings to respond to the rapidly changing landscape. This was the moment analysts had long speculated about, warning of its potential to upend the status quo, but few believed it would arrive so suddenly or with such force. The world had entered a new, unpredictable era, one where power and influence would be far more widely distributed, and where old alliances would be tested as new centers of gravity emerged. The old certainties were gone, replaced by a complex, multipolar future. In this new reality, nations would have to navigate shifting alliances and economic currents as the balance of power was rewritten before their eyes. Global markets convulsed, the US dollar index plunged, gold soared, and stock markets from New York to Tokyo tumbled. In Washington, emergency meetings underscored the gravity. America's financial supremacy was no longer assured. European leaders watched anxiously, caught between old alliances and new realities. News outlets declared a geopolitical earthquake. Social media erupted with Wujiaqian's dollar shakeup and Petro-Yuan. The world's financial system, long anchored by the dollar, was facing its greatest test in generations. The consensus was clear. The unipolar era was over. The global order, once centered on the US, had been irrevocably altered. The question was no longer if change would come, but how fast and how deep it would run. The shockwaves marked a collective awakening to a new, contested world. To grasp the magnitude of this shift, we need to look back at the roots of the global financial order as we know it today. At the heart of this order lies the petrodollar system, a financial arrangement that has shaped the world for decades. Born in the 1970s, it was an informal pact. OPEC, led by Saudi Arabia, agreed to price oil exclusively in US dollars in exchange for American military protection and political support. This handshake deal quietly rewrote the rules of global trade. This arrangement created relentless global demand for dollars, cementing its status as the world's reserve currency and fueling the expansion of international trade. Central banks everywhere began stockpiling dollars to buy oil, making the dollar the linchpin of global finance and the backbone of international reserves. The US could run deficits and project power simply by printing its own currency, a privilege no other nation enjoyed. This unique advantage allowed America to fund its ambitions at home and abroad. The petrodollar system allowed America to impose sanctions, fund its military, and shape the world economy to its interests, reinforcing its global dominance. For 50 years, this oil standard replaced gold, making Wall Street the financial capital of the world, and the dollar the currency of choice for international transactions. Most people never questioned it. It was the silent architecture of American power, quietly influencing daily life and global events alike. The pricing of oil in dollars was more than a convention. It was the foundation of the post-war order, underpinning decades of economic growth and stability. That's why the Gulf's break from this system is not just financial news, it's a world historical event, with consequences that will ripple across continents and industries. The petrodollar's unraveling signals the end of an era, and the beginning of a new uncertain chapter in global finance. the global financial landscape is being redrawn before our eyes, as nations and markets adjust to a new reality. The world is watching as the old system gives way to something entirely new, ushering in a future that is still being written. Accepting yuan for oil marks the birth of the Petro-Yuan era, a historic turning point in the global energy and financial landscape. For decades, oil has been priced and traded almost exclusively in US dollars, but now, a new chapter is unfolding. This isn't just about currency choice, it's about building a parallel financial system outside US control. By transacting in yuan, countries are creating new pathways for trade and finance, reducing their exposure to American oversight and influence. China, the world's largest energy importer, can now pay in its own currency, boosting the yuan's global status. This move strengthens China's economic sovereignty and encourages other nations to consider the yuan for international trade. Oil exporters can recycle yuan into Chinese goods, investments, and infrastructure, bypassing the dollar entirely. This deepens economic ties with China and opens up new opportunities for development and collaboration. For the first time in decades, there's a real alternative to the petrodollar for the world's most vital commodity. The global oil market is no longer a one-currency game, and this shift could reshape international trade dynamics. This shift will erode the dollar's exorbitant privilege, potentially weakening US purchasing power and limiting Washington's ability to use sanctions as a tool of foreign policy. The ripple effects could be felt across global markets and economies. The Petro-Yuan accelerates the internationalization of China's currency and elevates new financial centers like Shanghai, positioning them as major players in the evolving global economy. It empowers the global south, reducing dependence on Western institutions and giving emerging economies a stronger voice in global affairs. This shift could lead to more balanced and inclusive economic growth worldwide. The world's economic map is being redrawn with new trade routes and power centers emerging. As countries adapt, alliances and partnerships are shifting, creating a more interconnected and competitive global landscape. The dollar's monopoly is over. A multipolar currency world has arrived. Multiple currencies now compete for influence, offering nations more choices and flexibility in their economic strategies. The Petro-Yuan is the clearest sign yet of this new reality, a symbol of shifting power and the dawn of a truly global financial era. The expansion of BRICS to include Saudi Arabia and Qatar is the institutional engine behind this transformation. What began as a forum for emerging economies is now a powerful bloc representing much of the world's population, GDP, and energy. China has driven this expansion, using BRICS to challenge Western dominance and promote de-dollarization. By encouraging trade in local currencies, China aims to elevate the yuan and weaken the dollar's grip. BRICS institutions like the New Development Bank offer alternatives to the IMF and World Bank, now supercharged by Gulf capital. This is more than economics. It's a geopolitical statement of sovereignty and multipolarity. The inclusion of Middle Eastern energy giants links the world's factory with its gas station, forging a new axis of influence. BRICS Plus is not anti-American, but it's determined to chart its own course. The global order is being fundamentally reshaped by this new coalition. For Saudi Arabia and Qatar, this was a pragmatic pivot, not rebellion. The US once guaranteed their security in oil markets, but shifting American priorities and the rise of China forced a strategic rethink. China is now their biggest energy customer. Accepting yuan cements this vital relationship. It's a hedge against declining Western demand and a bet on Asia's future growth. The Gulf states are asserting autonomy, diversifying their economies, and seeking new partners for their ambitious transformation plans. Joining BRICS and embracing the Petro-Yuan signals they are no longer junior partners in a US-led order. Diversifying reserves and trade reduces vulnerability to US leverage. This isn't about abandoning the West, but about balancing East and West for resilience. It's a sophisticated strategy for thriving in a multipolar world. The US faces the erosion of its exorbitant privilege. Financing its debt will become costlier as global demand for dollars wanes. Europe, caught between the US and China, faces instability and tough choices as the world fractures into competing blocs. The security for oil pact with the Gulf is fundamentally altered, forcing Washington to rethink its Middle East strategy. For the global South, a credible alternative to the dollar offers new independence and diplomatic leverage. The unraveling of the old order accelerates the decline of American unilateralism. The US will remain a superpower, but must now negotiate and compromise in a multipolar world. economic sanctions lose potency as BRICS Plus creates alternative trade pathways. The unipolar moment is over, multipolarity is here. The world's alliances and power structures are being rapidly reconfigured. The transition is underway, and there's no turning back. This global shift will hit ordinary people, not just policymakers. In the US, a weaker dollar means higher prices for imports. Everything from electronics to groceries could cost more. Higher government borrowing costs may lead to tax hikes or cuts in public services. In Europe, a stronger euro could hurt exports and jobs, while market volatility threatens pensions and investments. For the developing world, trading in local currencies or yuan could lower costs and boost infrastructure investment. The promise is a more equitable system, but the transition could be rocky for all. A disorderly dollar decline could trigger a global recession, hurting workers everywhere. The interconnected global economy means shocks are shared. No one is immune. The ripple effect underscores our shared fate in a globalized world. A storm in one region will rock the entire economic ship. We stand at the threshold of a multipolar currency world, full of risks and opportunities. The challenge: manage the transition from dollar dominance without triggering chaos. Coordination among the US, China, and Europe is crucial to avoid crisis. Competition between currencies could foster discipline, innovation, and a more balanced system. Emerging economies have a chance to break old dependencies and shape a fairer globalization. The West must adapt, shifting from dominance to partnership and focusing on its strengths. Europe needs a unified strategy to avoid being sidelined. The goal: build a stable, inclusive economic architecture that benefits all. The announcements from Riyadh and Doha mark the end of one era and the start of another. The next chapter is ours to write, one of adaptation, cooperation, and shared progress.